Performance review for March. I'm just going to be going through a bunch of stuff I've written down and reading through it and explaining different things as I go. I've also got a few notes on the price action, but more than that, I'll just be talking through the price action. And yeah, but I'll do that all last. I'll start off with the more performance based stuff and then end up more on the price action and maybe even some setups. So yeah, to start with, mistakes and learnings, patterns of mistakes, and key lessons. So the first one that came into mind was front side entry, specifically on the soup at old high framework. So I need to remember this is a framework, not an entry model in itself. Otherwise, the invalidation, unless the invalidation is near and clear. So, for example, a intermediate term low, um, with an old low just above it, so I can stick the old low with a clear invalidation. What this basically saying is what I was doing before is have for example, an old low, let's say this, and let's say the dealing range that we're in is from up here down to here. So in quite a big dealing range, we're only part way into it, and I'm thinking we'll come down and I want to see us soup and then head back up. But if I just jump in on the way down, so I go buy here or here, then maybe it'll just keep on tanking and then take me out. And the invalidation is way too far away for the high time frame external range. So rather than doing that, I need to be waiting for a key low time frame change in state so that I can still use the high time frame invalidation for stop loss, but this would at least prevent me from getting annihilated by a singular down closing candle. So let's say if I waited for this, I could even wait for the change in state of delivery. We might get one here, and then I could enter in with my long there, and then I could still use the higher time frame invalidation because I do have a better hit rate using that. But then at least at that point, I'm not just catching a falling knife. So that's the first thing. I can also obviously use the low time frame invalidation if I've got a low time frame structure point, and especially if the case is that I do get the CSD and I get the CSD right here, then obviously I'm not going to go and use that. At that point, then yeah, use the closer invalidation low time frame structure. And if that gets invalidated, then wait for the same thing or just let it continue into the other side. So an example of that, I believe there's a nice example in here of a trade I took that didn't work out and for that same reason. So yeah, let's move this over a bit. So what that was is using this swing high. So this is the Asia high, I believe. Yeah, for Friday, Asia high. You can see we make relative equal highs of it here on Sunday. So Sunday going into Monday, Asia. So really key level. And I was bearish looking for a super short to take these lows. And we initially sold off, came up, that's offered a nice super entry there. However, we broke down lower and I didn't quite catch this entire move. I got in there, but then I closed out thinking it would come for another soup, which is another mistake, but separate. And then as we came back into it, I thought, okay, well, I'll just go short like that. So soup short with a stop wherever up here. And as you can see, if we look at this 1 minute price action, we never had a change in state of delivery, even on the 1 minute chart. So if I had been waiting for at least a change in state of delivery, then I would have only got that, right at the top, or by which point I wouldn't be interested anymore. Like it's not looking wrong time of day and it's clearly not what I thought it was. So yeah, so either waiting for something really clear that's showing me that it's time to get in, but not just blindly shorting on the way up because we have these clean old highs. So that's the first one. And then the next thing that I came up with was I learned what constitutes a high conviction trade versus a lower conviction trade. So what I got that down to is the order in which I identify a trade being framework, narrative, the framework first, then narrative, then slash bias, and then the time slash low time frame entry model. So I noticed how there seems to be a few distinct ways I come up with trade ideas and that some work better than others. Framework first, then narrative, then entry model and time. This appears to be the ideal method and tends to be how I go about trading gold and silver. What makes this method ideal is that we are starting off with something that is visible and clearly exists in the chart. So I'll exit this. So an example of what I mean here is when we have something that is visible and clearly exists in the charts, I mean that I already have a clear, like a framework. So for example, this here, this is a impulse high with a drop back down. We then imbalance the entirety of this range. And once we do that, one of my frameworks is that I like to see a low resistance run into that impulse high, which we get from over here. Now, if I start off with this as the framework, that's okay, I can see a framework and price that I'd expect this certain outcome. I can then identify I might know the statistics behind it, like a certain percentage of time this happens. And then I can form fit a bias around that. So I can see, okay, well, I can see this framework and I'd anticipate a low resistance run into that buy side at some point in the future. And then I can go to the higher time frame and then identify, okay, well, what's it showing me here? Well, we're expecting this fair value gap. We've dropped into this gap down there. Like you can just from there go and create the bias from things that don't yet exist, because at this point, like all this stuff to the right doesn't exist, and I've got a framework that I think this high will get taken out, but I can't see all this yet. So because I can actually see this framework, that makes more sense to start off with that and then go and develop a bias surrounding that rather than going, okay, on the daily charts, looks like, we might be having a CSD and going lower. Okay, now let's drop down to the lower time frame. Okay, now I just want to find a short, and then ignoring all this clear framework that is here versus on the daily chart that's just looking at what order flow is being respected. So I'll read through the rest of this and then I'll go back over that again in case I didn't explain it too clear. But yeah, what makes this method ideal from framework, then narrative, then bias, then entry model / time. So what makes it ideal is that we're starting off with something that is visible and clearly exists in the chart. So right off the bat, I have some understanding of the developing trade idea's expected value because of whatever win rate is associated with that particular framework. So for example, let's say this is a 70% of the time we hit this high, then at least I can start to formulate the expected value of this trade idea depending on where I get involved in within this range. So it's a big step towards coming up with the idea. The next distinct way I come up with trade ideas, and I have in the past, and I only really thought of this last week, but is starting off with the narrative / bias, then going to the entry model / time. This is clearly flawed as it's missing the framework, which is essential because the framework confirms the narrative and tells you the invalidation. This tends to be how I come up with and execute trade ideas in the indices. I know that I want to take a trade around 9:30 open, so I first come up with a bias going top down, and then I skip right to the entry model. This results in forcing an entry because of my bias, with no clear framework. Rarely, I'm right and it's happy days. Or way more often, either I get taken out multiple times before it works, sit through some excessive drawdown, or stubbornly take stops and re-enter while ignoring really nice clear price action that's shouting about opportunity going the other direction. So as you can see, if we're missing the narrative, the framework, and I'll go over to NASDAQ to explain this part. But for example, over here, so let's say I started off here thinking that it would be a long because I started on the high time frame. I need to replay this actually. So starting on the high time frame, we just closed this day. I saw how it would closed above this previous day low and above this previous day high, and I expected us to remain to do a small sweep below that and then head up and fulfill this new week opening gap that I expected us to reach up to. I do not know what's wrong with this indicator. It's completely not in the right place, but that's our new week opening gap up there. So I was thinking that we'd buy on this line, head up to there. So this is starting from the top down. So this is just going with the narrative and bias. The narrative that we are making this low, we're going to run up to a premium and then sell off. And the bias just starting on the top down, showing, we could have some bullish order flow, then dropping down and looking for what confirms that. And if we ignore all this stuff here, it was kind of looking like that. And yeah, just working my way down, thinking, okay, cool, I'm looking for longs, I'm looking for longs. So ignoring the fact that there's all these other features in price that could be indicating that we're likely to go lower. And if I do that, then what ends up happening is I start forcing an entry. So what I did in this particular situation was I bought as we dropped into this inversion fair value gap from the 5-minute chart. And with an idea that we had this old previous day low, we like to hit that. And so I thought, cool, I'll just buy right here and I'll have my stop down here somewhere. But I gave it more room because I was on the Forex pair and I wasn't too sure it would move. Actually, my stop like right there, just missed it. But yeah, the problem is that at this point, it's super clear and obvious that it's hitting low. We've completely balanced this range. We've disrespected mean threshold of this balanced price range. But because I started with the narrative and went top down, I was stuck to the idea of going long. And so I ended up taking longs through here when reality we're showing really clear, nice price action that we're hitting lower. So that's an example of how I usually come up with trade ideas on the indices and how that doesn't really work because I don't have the framework. Some of the frameworks I really like to use are things like a failed bull flag or just anything where I can build a clear narrative of who's offside in price. See if I can find a quick example of a failed bull flag, such as this one here. So we have a nice rally from the PM session going into the close and then a bull flag, and then we just start consolidating sideways. So all this consolidation, I have the framework now is that I'm looking for a failed bull flag, in which case this is the draw and lower, and then I can go from there, and I'll just replay this. And then from there, I can go up to the higher time frame and just whatever time frame I want, but then go, cool, now what would support that? Well, we're clearly heading for the sell side over here, and we've been showing that we're respecting this fair value gap nicely. We've been sweeping above these old relative equal highs. Just various things that confirm that the high time frame narrative and bias is in alignment with what exists already. Because a bias and the high time frame order flow, that's just reading the order flow. That's just this green candle is holding price, so we're going lower. we're breaking through these bullish order blocks, and so it's showing bearish order flow, and that's great. But when on the lower time frame, I can see an actual framework that exists, and that can also be a market maker model, or just whatever kind of framework I want, but something that's clearly there. Like, you can't tell me that there isn't a rally here and consolidation. Like, it's there. So if I start off with that and then go to find the out if that's in alignment with high time frame bias, and then from there I can go to entry and time of day. And so whatever that would be in this scenario, you'd find your entry and the time of day that you're looking for. And yeah, so I think this is really important because it also allows me to better formulate a trade plan and not get caught offside, because I'll give another example of me being offside. A nice example of me being very offside. So there's our new week opening gap. We had SMT with RTY. So RTY was making a lower low and going into the new week opening gap. And so all of a sudden I was coming up with this bias that will hit higher, because we had on RTY there was a unmet daily SIBI, and then on YM we also had a lot of smooth highs and a lot of potential to go higher. So I was thinking, well, maybe we'll get this SMT and head up. As you can see, there's no clear bullish framework. Like, there's nothing in here that suggests, cool, this is looking nice and bullish. In fact, the complete opposite is true, where on here I have the narrative and the framework that we should be hitting lower. And for me, what really stands out easily is just this long wick, enticing longs at the open, then having a failure swing, rolling over heavy. And so the framework here is that we've got trapped longs, and I'd expect the midpoint of this wick to hold price. And so I could have used that as a way to build a framework and then look at the high time frame. Yep, it looks like all the evidences are agreeing that we're going to these lows. And we clearly have this unfilled new week opening gap as well. So if I started off with the framework and then I go to, then I can do my top down and say, oh, you know what? It does look like it could just melt. And the high time frame technicals are supporting that narrative. And then I can drop down to whatever entry time frame and then look for the entry at time of day. In this case, we have the 9:30, opens up, makes a low, runs for internal, and then rolls over. So starting off with the narrative is really important. Not narrative, the framework. So what I can see in price. The next one, getting right back in after a stop out. So I think a lot of people do this, and I'm no exception. And so I had a bit of a think through what triggered this and some solutions. So the trigger for me is when I have not used a high time frame invalidation for my stop loss placement, or clearly defined what invalidates the setup. This is also an example of that. So I had the idea that it would be a long because we had that. I just wanted to see SMT for some reason. I was forcing it for sure, but I wanted to see SMT with the new week opening gap. And initially I was getting stopped out, having my stops at the lows. And then as we dropped into this, I fairly impulsively re-entered the trade and just had to stop arbitrarily down here somewhere, thinking, well, maybe it'll come down. I'm going to change that color, it's annoying. Maybe it'll come down and, sweep below here and then go back up or whatever. Obviously, that completely is against the narrative I had wanted to see, but yeah, I'd already taken multiple stop outs in here, and re-entering the trade was just simply because I didn't have a clear invalidation. If my invalidation was, okay, if we hit this level, then it's no longer the trade idea I thought, then that's the invalidation. Or if I had a clear order block. So let's say I was looking for a long on this order block, high time frame invalidation is here. Now, let's say I was looking for this long, and my high time frame invalidation is down here. If I was to buy here, and then put my stop, like, I don't know, here or something, and price came down into it, then all of a sudden, it hasn't actually invalidated the trade. And so I might, if it rolls over low again, I'll think, well, I mean, technically it hasn't invalidated, so I'll re-enter down here, and so on. So that's can be solved by keeping the stop loss down here, and at the high time frame invalidation, and yeah, but there's also an exception to that rule, and that's if the high time frame invalidation is really really far away. So let's say, as a random example, maybe I think that I want to go short here. I don't think it's going to go into this upper fair value gap, but it kind of could, but it shouldn't, but it could heat up here. So I want to get involved on the short in this area. Let's say I wanted to sell into this wick or something, or this mitigation block. But yeah, I didn't think it would go up here, but it could. And if it did go up here, then my invalidation would actually be all the way up here. So obviously I'm not going to just go short here and put my stop up here. So in this scenario, this I've written down here, is if the range to high time frame invalidation is too large, then I need to wait for a low time frame change in state and structure to frame risk. Otherwise, use high time frame invalidation wherever possible. And that's again because I have a much better hit rate when I use the high time frame invalidation. So in this scenario, I'd be, wanting to get short somewhere in this area. I don't think it's going up here, but it could. So what I'd be doing is be waiting for a change in state of delivery at a key time. So let's say we're coming into the open. I can see that we've had this failure swing. There might be some SMT or something. And then I can see that we had a change in state and a nice order block to get short from. So that would be the way to play that. And then I'd be using the lower time frame invalidation for my stop, because if it goes up here, then it could go up to here. Yeah. So that should solve getting back in after a stop. Use the correct invalidation, which is high time frame wherever possible, or low time frame if the range is too large. The only other reason why I'd use the low time frame is if the price action is suggesting that we should have speed and distance. So say in this scenario here, we're rolling into 930. I can see that this is likely to be a breakaway. We're probably not going to come back in here, and then we displace lower again, and I decide to take a institutional order flow entry drill right here. So in this case, I'm not going to go short there and put my stop above the order block. The whole premise behind this entry is that we are heavy, this should be a breakaway. So I'd be putting my stop at a lower time frame invalidation, such as above the midpoint of this breakaway. That's the only other exception. Next one. Seeing is believing. The hierarchy of the visible to the invisible. So along the same line to the ideal methods of coming up with a trade idea, starting with the visible framework in price, the visible things that do exist in price should be given more weight than any hypotheses, biases, or wishful thinking. This is what allows for flexibility intraday. So if I have an incorrect bias on the day, but then I see something like, let's say I'm looking for longs here, but then I start seeing this, because let's say I'm bullish, I think we're going to take up these relative equal highs. And I'm looking for longs, but then I see this framework. So I've got on the low time frame be a bit cleaner, but a nice bull flag. We then have a false breakout of the bull flag and a failure and break back down. whoever got short on this breakout and have their stops down here. So now the lower time frame is telling me, okay, well, it's showing the visible is indicating we're going to go low. So that's what allows for flexibility, because the framework of what I can actually see trumps any biases or wishful thinking that I have of going up here. One of the situations that really drove this point home for me was the way I got caught up in my hypothesis of YM making SMT with the new week opening gap, so Sunday open, and how I held on to this all the way into Friday, despite there being no clear structure or framework to confirm this. Having a hypothesis is great, but if there is a structure/framework that opposes, then I need to reevaluate with weights given to this visible stuff that actually exists. So that's just talking about this example again, where I had a hypothesis/dream/wishful thinking that we're going to make a higher low and head higher. And that, yeah, I was holding on to that on this day. I was thinking that, so I ended up buying in here. They got taken out. I tried again here. I tried again here. Whereas if I just changed my tune to what I could actually see in price, I would have seen that, okay, well, the hourly is actually showing like some heavy bearishness, and it's confirmed by the other indices as well. So that would have been, yeah, the way to do it. The next one, getting positioned ahead of 8:30 when technicals were not there yet. This is on gold mostly. So I'll zoom in just to a random 8:30, like this one here. So if I'm looking for a short here, like if we're coming into 8:30, this is 8:30 on this candle right here. But if I'm getting short in this area and it's not really clean technicals, it's really high resistance, then all I'm doing is just getting a terrible entry for something. If I'm doing that, and then we have 8:30 happen just here, get a small rally, we then run up, sweep this internal range, and then break down aggressively with this failure swing, offering a really clean entry right here. So that's one example, but there's a lot of examples of this in gold. Haven't looked at this one, but let's see, try and find a nice example of it. This is a good one. So on this one, let's say I'm looking for a short. We have 8 a.m. just here. We're then just consolidating sideways. We begin breaking down. If I decide to get short at 8:24, that's kind of useless, because then we have 8:30, and then we rally up, have a really clear raise, a clear displacement lower, and that offers the nice short. There were one or two occasions where I ended up getting taken out early because of just getting in ahead of 8:30, and that also happened, I believe, on Friday. It did happen on Friday, yeah. So this is the 8:30 candle here. We even had 8:30 news. That's 8:30. And I had gotten short right here, just as we're coming up to sweep this high. And sure, as we had 8:30, but what I've noticed that if the raid hasn't clearly happened like well prior, then the raid tends to happen after 8:30. So here we get the raid, and then a shift and a nice sell-off. So yeah, just waiting for that 8:30 to do a raid if there is no clear technicals, because in this case, kind of smooth highs. We haven't really, made a clear breakdown into the range. We've just swept out this low. So there's nothing on the technical side that's screaming short now ahead of news. And yeah, so my belief that news works for me is good. But if there hasn't been an entry yet, or if there isn't a clear framework, so right here, there isn't a super clear framework. I was thinking that we could have had this super above the old high, but it's not super clear. So yeah, their news will more than likely either offer a Judas for an entry, which in this case it does, or give the required narrative to allow me to put on a higher conviction trade with real size after its release. So in this case, looking for a short, I trade the 1 minute, not the 2, but for entries. But prior to its release, like I don't know where to put my stop. Like, do I put my stop here? Doesn't need to go up here. Doesn't need to go up here. Like, I can't put on size if it's super unclear like this. Versus waiting for after release, then we've clearly hit the raid. Now I've got the narrative. Okay, there's stops down here. We've dropped back down, come above this buy side pool just here, and now I can go short above this buy side with a lot more size because I have the narrative intact that we should head lower, and there's likely a reason to put a stop there. And then I put a lot more size with confidence versus might work, might not. I don't know. And my stop could go anywhere. So next up, we're on to the next section, which is what works really well. A 7 a.m. Judas in gold. This is the first thing that stood out as something that works. I've been noticing recently, especially on gold, is we have 7 a.m. right here. And when I get to the chart, like I usually get the chart around, try and get to the chart around 6. And then we can see what happens. Usually don't take a trade until at least after 7. But in this case, we have 7 a.m. open up and we don't Judas lower, we Judas higher. So when I have that happen, then I can trust any short setups to head back down to that level and sweep out the sell side. There were multiple examples that I should be able to quite easily find of this. Here we go, here's another one. So that's the 7 a.m. open. So 7 a.m. opens, it just goes one direction up, and we have an old swing high. We show an unwillingness to take out the high, we then get the failure swing, begin breaking down. And so because we've had the Judas, I can trust that we're likely to head back down lower. So a few examples of that. And then the next one thing that worked really well, Monday midnight. Held at a premium to Monday midnight, or just any midnight, with no retrace during regular trading hours. I'll bring that back to NASDAQ. This is something that we see happen quite often and almost always results in a nice sell-off like this. And I'll place this here. So that's midnight here somewhere. The fuck? There's midnight. So midnight on Monday. Usually you want to see us retrace to it during the regular trading hours, so around 9:30 or somewhere during regular trading hours, retrace and then go wherever. But when that doesn't happen, then I leave the Monday on my chart. I just do that and label it as Monday. And I see all this as being held at a premium above midnight for Monday. So I expect at some point we should head down here and take this out. And then when that aligns with my higher time frame narrative of us heading up into this balanced price range and respecting the mean thresholds, not getting above that, then when I see all this SMT and begin to break lower, then I can really trust it and trust that we should head down here and likely have a major sell-off. So this was a really nice framework and that just works really good. So this basically always results with us having a beautiful sell-off as we got on Wednesday, the 26th of the 3rd. So today. There was also very clear SMT, so it'd be worth studying the commonalities between this and past examples. This looks very familiar to me. Like I've seen this kind of patterns up here, and we have SMT and things. So I'd like to study how this compares to past examples so that I can, with more confidence, get in up here. On this particular day, I got in, I believe, here somewhere for a short, and I held that down to the midnight price. But yeah, I'd like to study some more past examples. There are some really, really clean ones from this year that look basically exactly the same as this. Next, targeting trailed stops following a one-sided move in gold, especially with the confluence of the 7 a.m. Judas. It's pretty self-explanatory. When we have a one-sided move, such as this one's a nice example here. I'll just do this. So we have a one-sided move, we then go sideways, we then have 7 a.m. Just in here, which, it's not really a confluence in this day, but one-sided move and then just targeting where the trailed stops are. So in this case, we have an impulse low down here, nice to target. Also new day opening gaps and just down here as well. So attacking those trailed stops after a big move. Just another example, we have this large drop and then attacking the buy side stops, have this big rally attacking these sell stops. New day opening gap, daily opening prices in gold to pinpoint entries. So this is incredibly accurate to the point of missing 3 different A plus entries due to placing my limit in the new day opening gap instead of slightly short of it. I will bring that up if this is in the right place now. Hopefully it is. Yeah, so this is one example. This was where I was looking for that run up to this impulse high up here, which we got beautifully here. And just prior to that, we swept out this discount sell side. So we draw out this range from this high to that low. We were range bound within there. And all you want to do is look for a soup long from below equilibrium, which is here. We drop down into the sell side. I had my limit order sitting at this new day opening gap, or basically got missed by a point because I saw how we had this old low. This old low, we had a really clean soup below with this order block, and if not using this order block, then this order block here also did it. So I figured what I'd do is I'd buy the soup below this old low again because it's a discount of the range. I'd put my entry at the new opening gap and I'd put my stop down here. So what it looks like, look like so. And what ended up happening, if we zoom in real close, is we fell just short of it by like a point. So in the future, when I have a clean entry and a new opening gap I want to buy, rather than putting my entry there, I need to put my entry there, like just a bit above so that I can get that entry because it tends to be extremely accurate. Another example that I missed as well, when we had the sell-off, still bullish with the all-time high sitting up here somewhere, fell short of that, drop back down after the 830 with a little market maker buy model, the original consolidation here, tear back up. I was looking for a long, trusting we shouldn't go below this order block and not below this because there's no inefficiencies down here of all these boxes. And so I thought, cool, I'll buy the soup below this low at the new day opening gap, with a stop below this low. And because it's trading Forex and I literally got tapped but not filled and missed out on the move. It did actually offer a nice additional place to be getting in. And this is another thing I might bring up real quick of how something I can do better. When I have a clear entry area like this, I wanted to buy below this impulse low. And we hit this entry. Let's say I get missed on my entry here, I didn't get filled. Rather than just going, oh shit, well, I've missed the whole thing, screw it, I'm not going to touch it now. Just, okay, well, I just want to sell somewhere within this area. Anywhere in here is fine. So I can move my entry up to there, change the size appropriately, and then I can still catch the move. So not demanding pinpoint precision, if I don't get the perfect fill that I wanted, because at this point I'm just feeling like I got screwed over because it's went exactly where I thought, but it didn't fill me. And then I don't want to buy it higher up because I feel, it's not fair. So that's just, a bit ridiculous thinking. I need to just, um, you know, be more flexible with my entries in the sense that all it needs to be is above a buy side or sell side pull. All I need to do is sell to buyers or buy from sellers at a good price. Next, waiting for a raid post 8:30 when looking for a reversal in XAU. Already went over that. High time frame invalidation to frame risk. Already went over that as well. I'll read through it. This gives me a much higher hit rate, so I should use this wherever possible. There are certain times where it's better to use low time frame invalidation, such as when the range to high time frame invalidation is too large. Wait for low time frame structure. Already have size on using high time frame invalidation on a high conviction trade, then pyramid an additional entry on the low time frame and use a separate stop loss on the low time frame stop loss. And when the framework suggests that the price needs to remain heavy and the entry reflects this, example, institutional order flow entry drill because of a breakaway gap, which I already did, but I'll quickly explain this one. Already have size on using the high time frame invalidation of a high conviction trade. I can give an example with YN. Just on the 5 minute. So this would be seen back here somewhere. Here we go. So I was short from up here, and then I added on this soup above this old high. So I was already short, and then I added to the short here as we souped into the Sibi. So at this point I had some good size on. I was happy with the size I had on, and my entry average was probably up here somewhere, but let's just say for the sake of it, entry was here with a stop up there. And now I've got my size on, but I'm looking for potential lower time frame entry. So rather than trailing my stop or if I entered, let's say I see us begin breaking lower, we swooped this buy side here, took out that buy side, began breaking lower. I see this wick up here and I get short again. Obviously, I'm not going to get short here and put my stop up here. If it's a high conviction trade, which this was, I'd be looking at, okay, cool, I can see I'm going to leave the stop where it is. And this lower time frame trade, I'm going to get involved in and then treat this separately. So that's with risk management and also profit taking. So obviously with this one, I'm going to let that, play out the majority of my expectation. But then with a trade like this, I can add on additional size on a high conviction trade, take partials earlier. So as we hit this internal range, I'd be taking something off, and then I'd be reducing risk or whatever. But treating it separately and also yeah, just pyramiding on the low time frame but using a separate stop loss. Then once again, this is the ideal entry was this when we have the 11:30 candle right here. 11:30 lunch macro or attack whoever's been in the money all morning. That's clearly whoever was long from the open with his bull flags. bull flags. 11:30 raids buy side, begins aggressively breaking down with a change in state. We then also have this nice wick. And so at this point, high conviction trade, times alignment, everything's there. Then you can get short and use a separate stop loss again, taking partials and then holding the remainder. So just treating it separately works really good. Process wins, things that did really well and should take note of. So daily game plans are on top of the list of shit that works. That's because they have been really working. What I do for game plans is I simply use voice notes. I'll open it up and show it. So voice memos, I just record each morning a game plan, usually about 10 to 15 minutes each. And then occasionally also I might have like a weekly game plan or a review at the end of the day, just to go over things. It helps me to organize my thoughts for the day, come up with a trade plan, and things like that. So that's been working really good. Video reviews of the day. I did these fairly often this month, and it was a very effective and efficient way to recap the day's trading. It brings to light what I need to be working on. I think I should make a habit to do this on any notable day, red or green. So if I ever have a really, really good day, that's definitely worth getting some extra reps in, going over a few more times. And then also if I have a really difficult negative day that's is a lot of the time really painful and you just want to block out, but getting on and talking through it can really help to bring us new lessons and actually make you way better. So going to make a habit of whenever I do have a notable day, definitely want to prioritize a just a video review to talking through everything, what executions, what I was looking at, and what happened. Review of emotions and psychology. So psychology wise, I believe I'm developing a sense of confidence in myself and my mindset that has been notable this month. This is being cultivated by the many other traders I listen to on podcasts, as well as discussions I have within my pod. Listening to other traders, like you can really hear a profitable trader and how they think, and obviously everyone has a slightly different mindset. But listening to people talk, just you can really pick up on key things that clearly are important to be able to think differently and think more like a consistent trader. Also, for the first time, I found models that I can internalize and have been able to build conviction in, namely the soup at old high/low model, which I began to develop at the start of Feb. Although there is still a lot of nuances left for me to dial in, I can see plenty of clean examples of the chart. Find an example real quick. For example, here, could just use this old high. Pretty straightforward example, but we had it there. It's not super clean, actually. Here's this one. So obvious, significant old high. You can see it nicely on the 1 hour. Or the 15, you can see it actually, but we can use that as well. A significantly nice old high that would just face through, would then break back below, come back up to soup it and drop lower. That's a rough example of what I'm talking about, but yeah, what I can what I conclude makes this work so well for me is how it's really a framework, and this framework can be applied to whatever narrative I'm seeing. Then it's also not overly specific. It's just a soup at an old high. Simply means we went above an old high. So they can be anything like this is an old high. We went above the old high, and that's a soup at an old high. Really simple and straightforward. And you could use the same thing over here. Like if I identify this as the key high, we retrace, break back below it, then we get in the soup at old high. If I have the other things, the other framework and understanding of order flow that supports the idea that this should be sitting us lower, then I can use that as my framework and model, both either or. But it works quite good for me for that reason. Also, it gives birth to more clean narratives and models, such as the order block that's formed following the soup at the old high. So when we have a order block that's clearly forms as we soup an old high, then I can then use that order block as a nice entry. Again, not the cleanest example just here, but there are clean examples in places if I could be bothered looking for it. I can just do a quick diagram to show it. So let's say we have this, we have this, then we have a soup, and then I can use that order block. And then if this is the old high that I was looking at, we can see that we ran above the old high. We then engineered a pull at the old high, soups that pull, and then we have a nice order block here. And in this case, I would be shorting with a stop above the order block. So that's all that's talking about, but that also works really nicely with this model. The next thing that helped psychology wise is thinking different. This is something I was thinking of last week. Essentially, if you want different results from everybody else, everyone who fails the trading, you need to think differently and have a mindset that challenges conventional wisdom. I am relentlessly internalizing this concept in my head to put my subconscious in the state of searching for the answer that I know exists. What is clear to me is that the way everyone else looks at trading is incredibly limiting and self debilitating. I will develop thinking patterns and mindsets that are incomparable and expose trading as the naturally simple craft that it is. So, this is kind of coming down to what you hear everyone talk about all the conventional wisdom of, okay, you have to have a stop loss here, you have to have 1 to 5 RR, like minimum or whatever, and risking this much of an account, or looking for a scalp, selling this fair value gap, uh, buying this 2022 model, just all this trading bullshit that's perpetuated across the internet. And if it works, then people would be successful in trading. And the people you hear talking about all the stuff that everyone does tends to not be doing too well. And if they have got a few payouts, they're inconsistent with it and they're struggling. I want to think differently than that, because there is a way to do it. Trading realistically could be incredibly simple. It's just overcomplicated by the way people think about it and look at it, and it's just people's thinking and mindsets. So I want to seek like a completely different way of thinking about trading, about everything I do. And if I can do everything in a way that is diametrically opposed to the way everyone else thinks, then I'm more likely than not going to do better than how everyone else thinks. So that's my thoughts on that. And that's kind of what I want to seek at the moment. A few things I jotted down last week after meditating on this. Long or short? One question. If price will go up, I'll buy. If price will go down, I'll sell. That's trading. Risk tiers based on balance. Exponential bet sizing on setup grade. So risk tiers based on balance. Let's say I have $100 balance, then I want to risk $20 per trade until I reach $120 of balance, and then I'll risk $30 per trade unless I drop back below 120, in which case go back down and then onwards. That way I can size up a lot faster, and then if it drops back below a certain threshold, then I go down to the lower tier size until I get back above it. So that's one way to scale a lot faster than making $200 a day kind of stuff that everyone does. Exponential bet sizing on setup grade. So a low conviction setup, risk $100. A high conviction setup, risk $1,000. So way more on the better setups. Just buy and sell when it's most likely to win. If I come into the day on, let's say, gold, and I'm zoomed in here, I'm like, cool, I think it might go up here and go down, but I don't know, maybe. But I'll give it a go because that's all I can see at the moment. There's no point doing that. Only take a trade and buy and sell shit when it's clearly more probable that you are going to make a lot of money versus not make a lot of money. So that's just being more selective, not forcing a trade every single day if it's not there. I only want to be involved when I'm, as I said here, just buy and sell when it's most likely to win. If it's not obvious as fuck, then I simply will not place a trade that day. When everyone is offside, I'm the one twisting the knife. Way to think of that. Let's just go and see what we did on Thursday and Friday. If everyone's clearly offside, I'm the one going short, and everyone's buying the dip. I'm the one shorting every single green candle, shorting. That's the kind of mindset I want to cultivate, where I can read when people are doing the wrong thing, and I'm going to be the one on the other side of the trade, twisting the knife. When I make money, I take it unapologetically. It's just a thought of how you get the typical, if it's not 1 to 3 I'm not taking profits kind of thing. Uh, really, if I take a trade and it goes into profit and I can tell it's going to turn around, then I'm just going to take the money. If I've got some nice money in, I'm taking it. Like, it doesn't, if I can tell that, the odds are changing and we're up, like, say I've got this mad trade idea and then it goes up here and I was like, oh shit, it's going to turn around now. I'm up some good money. Doesn't look as probable anymore. I'm just going to take the money because that's trading. The whole point of trading is to make money. It's not to catch your 5R every single time, because otherwise you're a bad trader. So unapologetically take that money. My mind is a factory for trade idea generation. This is inspired by Dr. Steenbarger's quote on how the best traders he knows have a love, the commonality between them is they have a love for trade idea generation. So I just want to be, constantly coming up with trade ideas, and I think that's a really important way that helps you grow. I pair my orders with pools of stops. That's pretty simple. It's just, if I want to go short, I just want to sell to these guys up here. So cool, there's some stops here. I just want to sell to them. That's fine. If I want to cover, I just want to cover below some lows or whatever. But as long as there's a significant pool of liquidity, that's my confirmation. So if I want to go short and we've hit a significant pool, and I've got obviously the invalidation and all that, that's my confirmations. We have hit a significant pool of buy stops when I'm bearish, and I have my invalidation and my setup and all that. This is confirmation because I'm selling to buyers at a high price. That's all you need for confirmation. I know it when I see it. That is very true. When you see it and it is clear and obvious, you're like, yeah, this is it. This is definitely it, and there's no question about it. The problem comes in when you've taken 10 trades prior to that happening, and then when you see it, like, wow, this is literally the trade of all time. This is going to go to zero from here. 19,000, no, 20,000 trade to zero if the market crashes next month or tomorrow. So if you've taken 20 trades in here, then you end up getting in a tiny size. So recognizing that if it's an actual really quality trade of a high EV, then I'm going to know it when I see it. And if you are able to just buy and sell when it's most likely to win, then you won't have cut yourself up prior to that ideal entry. So on the emotional side of things, I was stable for the majority of the month. The only time I felt I was losing it, mentally losing it, was when I was feeling a bit of financial pressure, and I knew there was something I could do about it by selling some things on Marketplace. So it wasn't until I had done all that was in my control and posted it up for sale that I began to stabilize. The important lesson here, goes along with what Jeff Bezos said in a video, that stress is just telling him that there's something he can do to improve his situation. So here I knew I was feeling stressed, and subconsciously I knew that there was something I could do. I could sell the stuff on Marketplace. So it wasn't until I posted it for sale that I began to reduce that stress, and then that related to a better emotional state with my trading. So in future, whenever I feel I have a stressor that's emotionally destabilizing me, I should prioritize doing something that will improve my situation. A little self-made quote: "The world can be burning around me, but so long as I know I'm giving it my all, I can be at peace within my mind." That's some bad spelling. Next up, so we've done psychology and emotional stuff. Next one is review of personal routines, fitness, diet, sleep, anything that impacts trading. So fitness routine fits in well with my trading currently. A few exercises in the morning, followed with a short run without audio is great for waking up, getting my mind grounded for the day. Throughout the day, I have a very casual approach of exercises just whenever I have a spare few minutes. Then at lunch, going for a longer run is great for making a clear separation from my training during the morning, and the more review type work I do afterwards when I tend not to trade. Diet has a few things that I can improve with. Firstly, I need to be more I need to have a more scheduled approach to snacks and coffee during the trading, because currently I'm just wandering away from the charts at random times for a refill of coffee or something. And sometimes this is just when I'm getting into a trade. In fact, it's probably not even random. It may be whenever it is uncomfortable that my stomach decides it's time for a snack. I think that could be a real thing. I've got some solutions low down about this, but I think that if I have a specific times I wait until, that would be a good start, as it would also keep my mind from wandering into the kitchen instead of focusing on price. So secondly, alcohol consumption. It needs to be limited. When I have 4 cans of beer, I'm noticeably less productive the following day, so I'll limit this to maximum 2 cans. Otherwise, a cold beer can actually be helpful, as it can give me a boost of motivation at the end of a difficult day, or when I'm tired to do a review that I'm always very glad I got done. So reserve beer for days like this and limits the quantity to 1 or 2. Finally, just a note on lunch. In the past, I found that if I trade after lunch, there is a heightened tendency to take impulsive trades. Also, higher carb foods can also be detrimental. So what I've been doing this month with just working on review work as I eat slash right after eating is good, because it gives me an excuse to do something more productive than just giving back the morning's gains. Sleep wise, I've been thrown off again by daylight savings. Expand this a bit. And have been struggling to get to bed, to get an earlier bedtime. This was very detrimental to my trading, because when I can watch because it is when I can watch XAU, so gold, from 6 a.m. that I have time to get nicely in sync with it, and also have time to get a read on other markets. Instead, I was getting to the charts more around 7 a.m. and often also underslept, or even later having slept in. Solution to this is firstly to always make sure I'm in bed by 1 p.m. EST. The next thing, not EST, sorry, this is New Zealand time, so 1 p.m. New Zealand time. The next thing is to eliminate light pollution by either having my windows effect, it's not written quite right, covering my windows effectively, or by making some sort of cover for my eyes/head. Additionally, I will investigate red lens glasses. So being in NZ, going to bed at 1 p.m, the sun's fully out, streaming in, and that's partly why I struggle to get to sleep in time. But yeah, this could definitely help. And this should be quite a priority, because if I can improve my sleep, this would actually be huge, because currently, although I'm trying to get 7.5, 8 hours sleep, like if I'm lying in bed for an hour and a half to 2 hours before drifting off, it's probably not that effective. Next, a review of your goals and approach going into March. So my approach had a core around the mantra, one good trade, and I remained cognizant of how every opportunity is independent from any past decisions or my profit and loss. This is likely a significant contributing factor to my psychology being in a good place this month. For goals in March, I only really had weekly goals of things I was working on for the most part, and they were fairly routine. There was one thing I wrote down on the 20th of March. That was to come up with a system to help me determine how much risk I'm allocating per trade idea to avoid taking multiple stops. That's what this image is down here. So this has a web of different components that are coming together. Firstly, I'll work on using the correct invalidation, high time frame or low time frame, as I went over before, in order to prevent excessive entries for a trade idea. Secondly, as I work to focus during executing, I will get better at estimating the expected value and assigning the appropriate skewed bet sizing. So if I can know the expected value of the trade idea that I have, then I'll be able to better put the right size on, and also understand the probability behind the trade and internalize that rather than just blindly jumping into trade. And then using the correct invalidation will prevent me from getting stopped out 10 times on one trade idea. Outlook going into April. So goals. I want to improve my ability to focus on the markets I'm trading and zero in so I can execute to the best of my ability whenever I have a position on. I want to have a dialed in singular focus on every part of that execution. A couple of ideas how this may be achieved are removing distractions, additional techniques to increase focus. As far as distractions go, snack breaks will be scheduled to a specific time, and I'll be audio alerted to these times to prevent my mind from just wandering by itself. During trading hours, I will eliminate opening Polymarket or X. Engaging in a live stream or space about live markets is fine, as it can help with sentiment and giving me additional ideas to consider. So it's avoiding entertainment that is outside of the actual trading session that we're currently in. Next one, a bit of proprietary secret information, but visual focus technique for fixation duration. So visual fixation and follow through throughout execution. Example that was given was of a golf put, then shows that the golfers who had a increased fixation duration on the ball itself, on the golf ball, had a significantly improved in performance. I think it was something like 1400 milliseconds was what the pro golfers would use, like focusing throughout the swing of the bat and hitting the ball, of their actual like pupils focusing on the actual ball itself. And then the lesser golfers would have more like 900 milliseconds. And it was even more so in various different sports, but it shows how just actually visually concentrating on something, like even if you want to focus on studying something, if let's say you wanted to study price action, rather than just opening the chart and starting going, okay, let's look at this, cool, this, that. If you actually go into price and before you start, just stare at something. So stare at the chart and just absolutely focus, like right here. So just draw a box and just go, okay, well, you don't need to draw a box, but look at that one spot for a bunch of time. I don't know exactly how long, but long enough that your focus actually sharpens onto the task at hand. So that's the idea behind it. And if I use that fixation duration of actually intentionally focusing on the trade I have on, then it should increase my performance. So implementation, active trade engagement. Phase 1, idea generation. So this is kind of like all the different times that I can actively be engaged with my trade and looking at specific things. So idea generation, I can, let's say I'm looking for a short here, and I think we're going to this low, or I think we're going to this box. See the target. I'm going to visually see where I think price will go. Then I'm going to visualize price in the entry. So we're over here. I can visualize, got the order block. I'm going to visualize price coming up, tapping into it. That's beginning to move low. And visualize the probability. So I can look at this and be visually seeing how this is probably a, whatever the probability I think it is. And that comes down to the expected value and how I calculate that. Phase 2, execution. So this is all the idea generation, the stuff that hasn't really happened yet, but what my expectations are in price. Phase 2, execution. Limit and stop placement. So visually see myself putting in the limit, and visually see myself putting in the stop. See the quantity of risk of capital I'm deploying. So I'll see that, okay, cool, I'm assigning X amount of my capital for the day to this particular trade idea, 350, whatever. And then entry being triggered. So watch as price comes up into my entry, watch it tap my entry. Initial reaction to entry price. So do we reject immediately? Do we keep pushing up a bit? Do we get these wicks? It's just really concentrating on exactly what price is doing. Speed and movement of price. So watching these wicks and how we're, potentially enticing more longs with these long wicks and things. It's just focusing on what price is doing rather than getting in the trade, then kind of walking off to the kitchen to get a snack. Like, there's just, I want to be actually dialed in and watching the trade. Speed and movement of price. Displacements towards take profit or stop loss. Are we ripping up towards the stop, or are we displacing lower? Speed and movement, displacing. Watch how price reacts to opposing pulls, speed and distance. This is quite important actually. It's when we hit a pull, do we reject them immediately like we kind of do here? Or do we get these big candles that just do a lot of speed and distance through these pulls? And that's telling me I'm on side. If I was, as you can see up here, we hit this buy side and we begin to reject. We don't get any speed and distance through these highs. Watch the partial take profits get hit and the position size change. So as we hit my partials, let's say I take a partial here, discount internal range, I'm going to hit that. I'm going to watch it hit. I'm going to watch how my position size changes from 3 contracts to 2. And then trail stop with intentionality. So I'm not just going to half close my eyes and watch it move and go, oh, that's my stop. Oh, my stop. No, like blah, somewhere there. No, okay, it's just placed here. We're hitting this discount internal range. We should leave this open. Like I'm going to intentionally move my stop and watch myself move it to here. Visually, I'm seeing this. My focus is really exact. I'm looking, okay, I'm watching this path, like kind of like, but here we go. This is what I should be doing. I should be trading. Cool. I'm watching the entry. I'm watching, okay, I'm moving my stop loss now. Cool, I'm moving that. But yeah, just being really dialed in, and that's a reference to the video. But yeah, that's all for the review. Regarding the performance, I haven't really gone over the price action. I might do that, I might not, because it's been pretty long already. I might do that separately. But yeah, I'll see if I do the rest. But it's been a good, nice review, and not sure how long, but should be fairly thorough. Shout out to Ganondorf for coming up with this nice template to use. Quite enjoyed it.